Now, I know this is not the news that Australians with mortgages want to hear, but it is the right thing for the economy. I said in December that the board had been alert to signs of a pickup in inflation, and we cannot allow inflation to get away from us again. Over the last 2 days, the board has been examining what has changed since our assessment in November and what's driving the pickup inflation that we've seen in recent quarters. I think the key point to make here is that it's not just one thing. The pickup is due to a combination of factors across a broad range of components and sectors. Our updated view, driven by the latest data, is that demand was stronger than expected over the second half of 2025, and we think some of that strength has carried into 2026. That strength has also meant that conditions in the labour market have held up well and unemployment has remained lower than thought. Secondly, the economy is closer to its supply capacity than we previously thought, which means supply constraints are binding in some more sectors, and it's not taken much of a pickup in demand to generate price pressures. Years of weak to no productivity growth is a big part of that story. Thirdly, the global economy has turned out to be much more resilient than we thought, despite the ongoing high level of uncertainty and unpredictability. And finally, financial conditions have eased, and it's uncertain now whether they remain restrictive overall. The recent pickup in inflation and credit growth are enough to make us question this. So taking all these factors together, the board decided it was necessary to raise the cash rate. We remain focused on returning inflation to target. The board will continue to be driven by what the incoming data tells us about where the economy has been and what this means for the outlook.